You're listening to TIP.
On today's show, I sit down with Whitney Elkins-Hutten to talk about starting in real estate with limited capital and her thoughts on out-of-state investing. She is now Director of Investor Relations and Operations at Goodegg Investments, which has over 5,800 multifamily units and 1,500 storage units in its portfolio. Whitney purchased her first rental in 2002 and figured out how to make real estate investing work for her while working her corporate job until she was able to do real estate full-time. I'm very happy to have her on the show to talk about some of her strategies, successes, and lessons learned over the years, as she has helped impressively scale her and her company's portfolio. So let's dive right in.
You're listening to Real Estate Investing by the Investors Podcast Network, where your host, Robert Leonard, interviews successful investors from various real estate investing niches to help educate you on your real estate investing journey.
Hey everyone, welcome to today's show. As always, I'm your host, Robert Leonard, and with me today, I have a very special guest, Whitney Elkins-Hutten.
Thank you for having me. And you did it. You went German on me.
I know we were just talking about that before, and I think I put that in the back of my mind, but there's a lot of different things that I'm excited to talk about in our conversation today, specifically around creative ways for new investors to fund their deals when they aren't starting with a lot of money, and about long distance investing. But before we dive into those topics, let's get started from the very beginning. What was your journey like from where you started to where you are today?
I'm a Leo. I was born in Midwest Texas. Just kidding. I assume you mean the real estate part of the journey. I came to real estate investing, really as an accidental landlord. So back in 2002, I had the opportunity to buy a home and stop paying rent. And I bought a home with my significant other. The relationship fell apart after a couple months. I was the one kind of left holding the bag on the property. I had the loan in my name and everything. And I didn't know what to do. This was so long ago. I was young and I stuffed it full of roommates and it still needed a little bit of a rehab. I didn't have any more. My partner at the time was supposed to help me out with the rehab. That part of the deal went away as well. So I was like, okay, let's roll up our sleeves and get dirty. And what I found out is with a lot of elbow grease and $8,000, I was able to turn that into a $52,000 profit in 11 months. And this was back in the wild, wild west of financing. I was 103% financed on the property. So you could actually get an 80% loan to value and then turn around and get another 20% HELOC and have all your closing costs rolled in. And I could do this with only bringing $7,000 down to the table and then refinancing out with the HELOC and taking the $7,000 back out and giving it back to my grandfather for the little bit of interest. You don't know what you don't know. Fortunately, the deal went amazingly well for me. We were able to push the value on the property. And then 11 months later, I sold the property. And it wasn't until that time that I finally realized this was amazing. Like, I have money in my pocket, even though I've been sweating bullets the whole time. My roommates have been paying the mortgage for me. I was even pocketing $300 on top of that. And I was like, how many more deals like this can I do? So that's really what got me started.
Yeah, when you have a really good first deal like that, that makes you certainly really interested in real estate.
And somewhat overconfident. My second deal did not go nearly as well. It went a little sideways, as I think you're bound to have as a real estate investor, something go a little sideways. I got it on my second deal. I came out, that was leading right up until the 2008 crisis. So I actually was invested in a mountain town on my second deal. So that was 2006 and things had started softening there, but got out somewhat unscathed and then just thought I would kind of take a little hiatus for a while. At that point in time, I had met my husband and my husband was like, thank goodness you got out from underneath that house. And I'm like, I got it. I got this thing figured out. And now I know what to do to make a deal go right. And I know what not to do to make a deal go right. And then, we just kind of launched into a couple more live-in flips after that.
And did you use your 401k to get started?
I did not. Actually, my seed money was $7,000 that I borrowed from my grandfather and paid him back with the equity out of the house on my first purchase. So there started my seed money. We did 4 live-in flips that way. After our 4th flip, my husband and I took kind of a pause. I was in the middle of finishing up my doctorate. The housing crisis in 2008 to 2010 had really kind of taken a grip on the country. And we both decided to kind of focus on our careers and actually building a family at that point in time too. So in the capital we built up, that's what actually started our investing career into buy and hold rentals, away from the live-in flipping into buy and hold rentals. But then we quickly realized that we were going to run out of capital. That's when I learned how to unlock my 401k.
So I do want to definitely talk about the 401k piece, but before we do, define what a live and flip is for someone who may not have heard that before.
It's an interesting concept. I guess I was doing a combination of live-in flipping and house hacking. So to define both terms, house hacking is where you buy a house and you put roommates in it. If it's a single family house, you rent out your rooms, or if it's a small multifamily unit, like 1 to 4, you rent out the other units and you have the rent cover your mortgage as well, all or most of it. So you're reducing your housing costs. So that's a house hack. A live-in flip is where you move into the house, you're renovating the house, and then you're living there for a year or two to qualify for your capital gains exemption. And we can go over that a little bit because that's what makes this tactic so powerful when you're getting started. And then you move the property after 2 years, take that capital, harvest it, and then go trade it up for another deal.
I actually started in the exact same way. My first deal, I stumbled into a house hack accidentally, and then I ended up selling that. And then I live in a current live and flip right now. It's very minor. It's not like a big rehab full gut or anything like that, but it's definitely a live and flip. Talk to us a little bit about what you were mentioning there of the 2 years to avoid capital gains tax.
So there's a capital gains exemption. So currently as it stands right now, and I always suggest anytime that you're working with taxes or legal or anything like that, consult somebody that's professional in this area. So if you talk to your CPA, you will figure out that a single person can buy a property, any property. It doesn't have to be one that needs a rehab and flipping. But if you buy a property, any gains that are acquired in that property over the course of 5 years, you only have to live in the property 2 of the last 5 years. And you can actually, if you sold the property, you get all those gains tax-free up to $250,000 for a single person and $500,000 for a married couple.
And are those amounts of the profit or the sale price?
The gain. So the gain would be whatever your basis is. So if you bought the property, say for $200,000 and you put $50,000 of rehab and then sold it for $500,000 a few years later, your gain's $250,000 because you actually had your purchase of $200,000 and then your rehab cost of $50,000, and that's your basis. So you could essentially clear $250,000 tax-free.
And so is it anything above that starts to begin being taxed, or if it's above that, then the whole amount is taxed?
Great question. I would talk to your CPA about that. I think it is a sliding scale. We actually, our third live-in flip, we sold it actually before 2 years. Our last live-in flip we've been in for 10 years. It's this house. It's the one I'm sitting in right now. We flipped it so well that I wanted to keep it. But it might change this summer because the market has really taken off here. So we'll see. But our third live-in flip, we sold at 23 months. We didn't have it for as long. And so we paid a sliding scale difference between what we would have paid in the full gain had we just sold it outright versus what the clock ticks down, I guess I should say. I'm just saying it changes all the time. So that's why I always say talk to a CPA, because if you're hearing that 6 months later, it could change.
Yeah, definitely. We're recording this late March. By the time this comes out, things could be different, especially with everything we have going on. So what we want to do on the show is give you guys ideas, start thinking about the creative different ways you could think about tax strategies, not necessarily go file your taxes based on the information that you hear on the show. Get some ideas, then go talk to your CPA and handle the actual tax filings with them. But at least get some thought-provoking ideas. Yeah, some base knowledge from us here. So
it's such a powerful strategy.
Yeah, that's what I did with my house hack, my first one. And I'll probably do the same with the live and flip that I'm in now. I just crossed 2 years tomorrow, actually.
Nice.
So, yeah. So I plan on doing the same thing.
Capital Gains birthday.
Yeah, yep. So what do you think is the best way for a new investor to get started? Should they do a house hack, live and flip, go straight for a rental? What do you think is the best?
It depends. I know that's kind of like the classic real estate answer. It depends. Well, it does depend. It depends on your interest as an investor. What are you interested in doing? And it also depends on the amount of time you want to put involved into an investment, especially if you're going to be living in it. Like, you can't step away. If you don't finish the kitchen that weekend, it's going to be forever a reminder in your face. And then also, like, what your capital that you have to get started. What is that capital piece to get started? So, if somebody is really new to investing, very little capital to get started, I would probably encourage them to do some sort of house hack. If they can gather up a 3.5% down payment on a first-time home buyer purchase plan. Or I would even encourage them to maybe partner with somebody on their family to pick up their first property. House hacking is so powerful because you actually eliminate one of your largest, or significantly reduce one of your largest bills. So if you're doing that, and then you're actually saving what you would have paid in housing on top of what you're collecting in the house hack, you can actually catapult your investing career.
Yeah, I agree. I think house hacking is probably the best way to get started. And if you want to do a deep dive into house hacking, go back and listen to my episode with Craig Curlop. I think it was episode 3 or 4. He wrote the book on house hacking, so definitely go back and listen to that one. We do a deep dive into it. Now, I want to talk about your 401k strategy. I know a lot of people are looking for creative ways to come up with money to buy their deals. And I would classify as using your 401k money as a creative way. So I'd love to learn a little bit more about what you did and how you accessed your 401k money for real estate.
I took full possession of almost full possession of my 401k. So within a 401k, my employer at the time offered a Roth side of my 401k and a traditional side of my 401k. So I, just take a moment to go over the different pieces. The traditional side is pre-tax money that gets set aside. Okay. So you're kind of kicking the can down the road, getting your income to grow now tax-free, and then you're paying taxes when you withdraw it. On the Roth side, you're paying the historically low taxes that we have now, and then it grows tax-free. So it's after tax money. And then later on down the road, when you get past 59 and a half, you can withdraw the money tax-free. Up until 59 and a half in our current laws, you get penalized when you take the money out and the Roth side of your 401k. Now, there becomes, there's a crazy little nuance here that if you leave your job or you are let go from your job, you separate employment, you now can move that entire 401k into a self-directed environment if you would like. I highly suggest if you separate from an employer, moving it into rolling it over. Don't cash it out, okay, until you know what you want to do. It's called a rollover, in-kind rollover, to Vanguard or Fidelity or something like that. But you can even do what we call a self-directed provider, meaning that they don't just offer stocks, bonds, and mutual funds. They also allow you they're a trust company that'll help you invest in other asset classes, maybe in metals or syndication deals, or in this case, real estate. Now, what I did was I looked at what I had put in my Roth. We'd been maxing out my Roth side of my 401k, $18,000 to $19,000 for almost, I think, 8 years at that point in time. So there was a good chunk of money in there. I could take out my entire basis on that Roth side tax-free. So the basis is what I put in. So my gains I could take out, but of course I got penalized, right? Because I took them out early. So again, I partner with my CPA, and I was crying when I got let go. We all knew that was coming, because my entire operations team had already been let go. I was the last one left. So I was upset that day, because I had 2 properties in my name under contract, and I didn't think I was going to be able to close on them, but we got that all figured out in a couple hours. But then by the end of the day, I was kind of doing the happy dance, because I was like, oh my gosh. My husband was like, we're pausing. We don't know what we're going to do. Are we going to continue investing? Are we going to pause here? What are we going to do? And I'm like, I just got my 401k back. We're buying more properties. Anyways, that was the mover that I did. However, you can, like I said, there's so many different things that you can do if you can get your 401k into a self-directed environment.
Yeah, it's funny. I actually did, again, something very, very similar. I rolled over my 401k to a Roth IRA, and then I was able to withdraw the contributions tax-free, not the gains, but contributions. Mm-hmm. And I used that to buy a piece of real estate. That was what I used to buy my first house hack. And that was a great way for me. And I think it could be a good strategy for a lot of people listening to the show. Do you think using retirement accounts in this way could be a good way for new investors?
I think it's definitely something to consider. Especially, you have to look at the opportunity cost of what you're going to do with that money. So if you have enough money in there to still have reserves set aside for your own personal situation, now that can be other funds that you might have, like a cash account or something like that. If you have funds for your own personal situation, let's say minimally 3 to 6 months of reserves, and then you have reserves for whatever property you're going to purchase, I think that's a great starting place. If your Roth account is the only thing that you have and you're relying on it to play reserves and rainy day fund and all this sort of stuff, no, not at all.
Yeah, definitely. You have to take into consideration your whole financial picture before you just use that. Yeah, I agree.
Especially today, we have COVID. We haven't even talked about that, the elephant in the room. But, I think even now, like in the middle of this pandemic, it's just a great reminder that reserves and cash are king still. You can invest from a position of strength that way.
Yeah, I think having reserves, especially now, and we're recording this March 31st, which is in the midst of COVID-19 coronavirus pandemic. We were looking, I'm an accountant by trade, so I run all the financials for our rental properties. And I was looking at ours. I invest almost exclusively with my business partner, and we both work full-time corporate jobs, so we don't necessarily need to live off the cash flow. So when we started investing together a couple of years ago, we made the conscious decision to not take any money out of the rentals. We decided to leave it all in the business. So we were looking at it today. We have almost 9 months of reserves in our portfolio, and we have our mortgage paid ahead by 3 months. So we have essentially a year set of reserves. So even if we don't get any rent from our tenants for next year, we'll be completely fine.
We can kind of debate all we want if our tenants are going to pay. Tomorrow will be the day that we April Fools. No, just kidding. But I mean, tomorrow will kind of be the telltale sign of what's going to start. We're going to get visibility on what's actually really, truly going to happen. But again, I think this is a great reminder to go back to the fundamentals, make sure that you have your own personal financial situation, that emergency fund built up. That's what's going to help you sleep well at night. And even if you're still nervous as an investor, that's good. I'm glad people are nervous right now, even though they have reserve funds. I mean, A, it tells me you're human. B, it tells me that you're not going to just kind of not think about how to optimize the performance on your asset right now.
We were actually a bit surprised. We had all of our tenants pay us a week early for all of our properties. I checked, we use Cozy, and we got the email notifications for our properties, and we had all our payments come in. I think it was like 23rd or the 24th. We both looked at each other and we were just like, did that just really happen? Did we actually really just get all of our April rent a week early? We were contemplating going back and forth. Like, are we actually even going to get any of our rent this month? Just like you said. I mean, that's obviously the big issue that a lot of landlords are dealing with. But yeah, and I recorded it. I have 2 podcasts, one called Millennial Investing and the one we're on today about real estate. And I released an episode on that show all about COVID. And it's an stock investing podcast. And I spent almost the whole episode talking about personal finances. Because I think it doesn't matter what you're investing in, you need to have your personal finances in order. You have to come to the table, the investing table, from a place of financial strength.
And an understanding of how money actually works, right? Even if it's just basic. I mean, I don't think you have to be. I think on the real estate investing journey, somebody's just starting out, they're going to pick up a lot of tips and tricks and tactics and strategies. They're going to, become very ingrained in that. But just to get started, I mean, I see so many people, in various forums that I'm a member of that are like, hey, I got $5,000 and, my day job's like, how do I get started? And it's not to say that you can't. You just have to, if you don't have the money, you have to partner with somebody that does, because I think it's, today aside, the current situation aside, being very over leveraged or putting yourself in kind of behind the 8 ball, you're just kind of setting yourself up for a world or hurt.
Yeah, just because you don't have a ton of money to get started doesn't mean you can't. You certainly can. There are ways, but that doesn't necessarily mean you should. I always
just because you can doesn't mean you should.
Exactly. People need to make sure they have reserves. I think that's the biggest thing, and I want people to know that your first deal is never going to make you rich, but it can put you in a big hole to start with. Try to not lose big on your first deal. So if you don't have a ton of money, and maybe it's not the best time to get started if you don't have the reserves, because then if you end up going into a big deep hole, that second deal is going to be so much harder. Whereas if you just hit a single on your first deal, then you can continue on.
Another kind of piece of the mathematics that I think people miss is I do it too. I use leverage with all my properties. Leverage can cut both ways. So you hear two different things. One, that, the value of real estate never goes to zero. That's what makes it better than stocks, bonds, and mutual funds. And that, leverage can actually accelerate the profits on an investment. Yes, it can. However, if you use leverage on a property, you can go negative, and it can go negative pretty darn quickly. Especially if a new investor is starting off using leverage, partner with somebody that's already done it before. Get some really great guidance. I mean, like we said, we can't drive the point home enough. Have reserves so you can kind of dig yourself out of that.
If you set yourself up appropriately with the right amount of reserves, you can take advantage of that leverage that you can get in real estate that you can't necessarily replicate in a lot of different ways. And you can be pretty aggressive with that leverage as long as you have the reserves aside. Like our portfolio overall, we're pretty levered. We're 80-85% overall loan to value across our portfolio. I'd say that's pretty levered, but we have a year of reserves, so we're fine. But if you are levered 80-85%, you can't have no reserves.
Exactly. Case in point, I was speaking with an investor a couple of weeks ago and very nervous about whether his tenants were going to pay on April 1st. And I was kind of digging into his situation. I was like, okay, well, tell me more. Like, what's really, truly going on here? 9 properties in Idaho. He was showing me all the numbers on it. I'm like, this looks amazing. And 2 things were wrong. One, all of his tenants were in the hospitality or food and beverage industry. And not to say that it's necessarily wrong, but like both industries are on the sidelines right now. And then 2, he only had $6,000 in his bank account for both his own personal situation and his property. That's where you have to kind of take the big inhale, exhale. You're just like, oh, wow. Yeah, that's a challenge.
Yeah, that's the issue. And I try to teach people too, is it's a couple months without cash flow. Of course, that's going to hurt. Like, that's not great. Nobody wants that. Of course, as investors, rental property investors specifically, we want the cash flow. But if you have to go 2, 3, even 4 months with no cash flow, as long as you hold on to that property and you're able to make it through that dip, then that's the important part, right? You're not going to have a bad deal just because you missed 2 or 3 months of cash flow. But if you are forced to sell at a loss or you just can't hold it forever, that's where the deal just starts to go south that way. So now I want to talk about one of my personal favorite topics of real estate investing, and that's investing out of state. Why did you decide to invest long distance?
It goes back to, you don't know what you don't know. When we decided to make the transition from doing live-in flipping and just creating buckets of cash and then really putting that cash to use to create cash flow, and that was a whole mind-blowing concept to us. Like, we can take this and we can get a bucket of cash and get an income with it. What? We just had no concept of that. What drove us to do that was my husband works for the government. And then in 2016, the election happened. And for whatever reason, it dawned on us in that election, his benefits were just totally at the whims of political play. It didn't matter who was in office, just did not matter. So we decided that we had to take matters into our own hands. So we had that going on. And then also at that point in time, my company that I work for, we brought on a new CEO who we knew was going to reposition the company for sale. And generally, operations teams do not survive those type of transitions. So I knew my job had expiration date on it. So combine those 2 factors. We were like, we need an investment strategy that's going to create cash flow for us and then also a future value of appreciation. So I was like, guess what? I know how to buy houses. So we looked into buying more property in order to rent. However, all the people in our close network bought property locally, and they were totally happy if they just made $100 or $200 a month on an $80,000 down payment or $100,000 down payment. Do the math. That is very poor returns. I mean, we were one toilet breaking plumbing issue away from having negative cash flow on that property. Anyways, we did it. We invested. So we got going. We put a renter in place, and then the toilet broke. First 2 months, we didn't have cash flow. I'm like, oh boy, this is not going to get us to our goal. Like, we'll achieve our appreciation goal. But as the more I learned about real estate and the more I learned about money, that is not putting ourselves in a position of investing strength. The other thing, my daughter, we were dragging her to open house after open house after open house. She actually could evaluate a property very quickly. She was 3 at the time. So she would run in the house and she'd be like, Mom, it has no shiny things and the, appliances in the kitchen, the bathroom smells and the carpet's funny colors. Can I go sit in the car? We were like, we don't have our time back. And that was the other reason why we wanted to invest. And so at that point in time, we only had our first asset, probably held it. We were in month 2 or 3. I just pushed pause. I was like, listen, we don't have the cash flow. We will eventually get the appreciation, but how many more houses do we have to buy in order to achieve what we want to get there? And then we don't have our time back. So went back to the drawing board and I was like, we have to figure out how to buy houses were less expensive. So I started combing all over Colorado. And eventually I ran across a couple of forums, sub-forums on Bigger Pockets. And somebody said they could buy a cash flowing house in Indianapolis for $100,000. It would pay $1,100 in rent. I was doing the math and like, OMG. That $100,000 house made more cash flow than my $335,000 house here in Colorado. And I had less money invested in it. I'm like, and then somebody else gets to manage it. So I get my time back. So once we kind of put all those things in place, again, understanding what we were interested in, what our investing strategy should be, like how to create that alignment, and then understanding how we were going to take our capital and invest it, it just was a no-brainer to go out of state.
You talked about those other investors only making $100, maybe $200 a month in cash flow. And I bet that that's probably not even taking into consideration any reserves for CapEx, repairs, vacancy, anything along those lines. I'm sure that's not included in there. So when you take those into consideration, it's most likely a negative cash flowing asset.
Oh, yeah.
I'm familiar with that because people will just run the mortgage payment and then the rent and say, oh, that's going to be my cash flow. But that's not quite how it works, of course. And I know I definitely know what you're talking about there. And it's funny because I live in the greater Boston area. Prices are similar to Colorado. And I came to the same realization is we can buy a $400,000 property here, make $100, $200 a month in cash flow, or we can go and buy assets across the country and get significantly better cash flow. And so I invest as well exclusively long distance now at this point, unless it's like a live and flip or a house hack.
So we closed on our first property here in Colorado. We put it under contract on Christmas Eve. That was fun. Great time to buy real estate, by the way. Closed on the end of January. We actually ended up selling it 11 months later, and we quadrupled our cash flow with that one transaction. Actually, and I should clarify, just by taking the equity we had put down, our down payment, we had quadrupled the cash flow. We actually did get some gain off of the sale of that property, and so we were able to insert that too. But our down payment here, we were able to 4x that in another market with proper numbers in place too, with your CapEx, your vacancy, and your maintenance, and all of that.
Talk to us for someone who is new to the concept of long distance investing. Why does this even work? For someone, say somebody, I know a lot of people listen from the Bay Area or New York City, and they might hear you're buying these assets for these prices and you're getting this much cash flow. How does this even work in other parts of the country?
I kind of sense two different questions there. People have to live everywhere. They have to work everywhere. So really what we're doing is we're trying to find a cash flowing market where a growth market, right? Where the population is growing, the jobs are growing, businesses are moving in, incomes are growing, vacancy is coming down. So we are able to find markets that meet those metrics. Again, you're stacking all of the investing cards in your favor. So if you're investing in a market like that, then you have to treat it like a business and build your team as if it were a business. So a business owner doesn't necessarily, if I'm opening a retail chain, I don't have to be at every one of those store locations every single day for it to work. I just need to know how to pick the location and then hire the right team to run that location. That's a very similar concept when you're doing out-of-state investing. Most people don't invest it from a business mindset like that. But essentially, that's what you're doing. You're picking your team players, your AKA the operators that are going to run your business very strategically in markets that are going to stack those investing cards in your favor.
How are you finding those team players in those long distance markets?
There's a whole list of ways that you can do it. Referrals is one, talking to other investors. There's some really covert ways that you can do it by doing online research as well. And, Zillow will give you a ton of information. And so will Trulia. I would refrain from just doing a Google search and taking the top 5 people that pop up in your search. Now, that might yield you a couple names to look at, but really your number one source is going to be other investors Okay, going on forums like Bigger Pockets, asking around who's quality there, not necessarily which companies are posting their services, but really digging in to see who's using them. And then, get online and do some research. Who's posting properties on Zillow and Trulia for listings? Do you like their listings? Are they appealing to you as a potential buyer or a potential renter? There's so many different ways. I teach all my students or clients like about 15 different ways to find different team members.
Do you think long distance investing is a strategy that a relatively new investor could implement, or do they need to have quite a few deals under their belt before they consider it?
No, I think it's definitely something that a new investor can implement. I would highly suggest if you're going to invest out of state to get some sort of support in order to do that, whether it's a mentor or a coach, or actually flying into the market and getting boots on the ground and finding the team members yourself there and interviewing them one-on-one. You do need a lot of support in order to get going with that. The biggest mistake that I see with newer investors is they just, again, do that Google search, do a Yelp search. They pick the first property manager, the first realtor that comes up, and they're not seeing the results that they want.
What are some of the most common misconceptions you've found surrounding out-of-state investing? How do you debunk those misconceptions?
I think the number one misconception that I generally have to work with on people is, especially, if somebody's like in the Bay Area where their home costs $2 million or I could be $3-4 million. Kind of like what you mentioned earlier, they're like, how can I buy $100,000 property in the Midwest? And people actually live there. Like their frame of mind, they have a location bias that's going on. I did a couple of high-end flips last year. In these high-end flips in Kansas City, they put my house in Boulder to shame. And they were amazing. We flew out to Kansas City, took a look at it, personally walked a couple of them, after the team finished them up. And I'm like, can we transport those? I would love to live here. But yeah, it's just the land value hasn't been driven up like it has in other areas. But I would say the number one thing is the location-based bias.
Yeah, I think the same thing. And a lot of the properties we own in Texas, and they're $400,000, $500,000, $600,000 houses where I live, and I do not live in those types of houses here. So like the properties we buy down there are $75,000, but up here they're $400,000, $500,000 houses. So it's just, the deals are out there. You just need to know where to look.
Yeah. So speaking of Texas, my mom passed away a couple years ago, and we had to deal with her property, and her property was 5 times the size of our property, very high end, and it cost half as much. Now the taxes in Texas.
It's crazy some of the prices that you can find when you go long distance. That's exactly what I realized when I was a relatively new investor going long distance. I saw the prices and I almost thought they were too good to be true. I was like, I could buy a $65,000 property. It's going to cash flow $300 a month on a single family property. That's not bad. You're not going to find anything like that in the greater Boston area.
Well, you also have to think, there's a lot of millennials right now that are geo arbitraging. For example, Indianapolis is really developing their tech side of their industry. Somebody can work in New York City, pay out the wazoo for a single bedroom flat, or they can move to Indianapolis, still hold the same job, and they're renting out like a primo house. The other thing, when we talk about different biases, there's a class bias too. Sometimes people have to kind of take off the rose-colored lenses of which, if you're coming in and you have, say like you're a more seasoned professional and you might have some assets to your name, you kind of have to take off those rose-colored glasses because majority of the population, live in a C+ or a B class asset.
Yeah, one of my favorite things about long distance investing is always live where you want to live, invest where the numbers make sense. It's pretty simple, really. For me, it's just kind of how I approach my investing and how I approach my portfolio.
No, absolutely.
Working with all the clients that you have, what do you find to be some of the most common limiting beliefs for relatively new real estate investors?
Well, I guess let's start at the beginning. I think one of the first limiting beliefs is that they don't know what they don't know, and then that's going to hold them back. Another thing is when somebody is trying to think about getting into real estate, really I'll rephrase the question in my head. It's really about what are their objections to getting started. It's either the vehicle of itself, right? Will real estate actually yield me the results that I want? Is it really too good to be true? Can you actually buy a house, put a tenant in that house, and they pay rent? Like, can you trust that vehicle? Then it's a matter of controlling the outside forces. These are also the things that you cannot control. We cannot control that a COVID pandemic was going to happen. This is a black swan event. And we've already talked how beaten into the ground what we need to do in order to prepare for those type of events in the future. But those are things that how can you set yourself up investing from a position of strength to mitigate those external events? Then you have to overcome your internal belief. Can you actually execute on the strategy? And this is where I find a lot of my work is done with the new investors, is actually helping them understand that, yes, you can. We're going to create a roadmap. We're going to create a business plan. It's going to be grounded in numbers, not exactly what you read, not what you read all over a forum or in a book. We're not having to synthesize all that information. We're going to create a very structured roadmap plan that you're going to know exactly how to execute on a daily basis. That way, when we have the external event that does happen, we can bob and weave and adjust from there.
When you create that plan, what are you including in it? What does that plan look like?
You want me to give you out all my goods? No, I'm just kidding. A lot of people, when they get into real estate or they jump on a forum such as Bigger Pockets, they'll be like, hey, I'm so-and-so, I'm from, Arkansas, I'm getting new into investing. Where should I start? And somebody goes, oh, well, what's your goals? To me, that is the worst place to start because we haven't asked all those internal questions. So really, we have to pull back and ask ourselves why we're getting started. When you ask yourself why, don't do it just one time. You have to do it multiple times. This is one of my favorite exercises that Tony Robbins does and a lot of other mindset coaches do. But usually your first why, you're going to actually find that you're running from something. That's going to be the fear motivator. That's going to keep you working. Maybe it's getting out of a job or you have to pay a bill or I don't know. There's some sort of fear motivated drive to get away from a pain or a situation. But the deeper that you dig, you're actually finding out that you're running towards something. And majority of the people that I end up working with, we're attracted to work with each other because we're trying to take control of our time to spend it how we want to. Maybe it's with family, friends, traveling the world, to go do something more purposeful that they're passionate about, but they want control of their time. And you have to start with that process to figure out what you're running from and what you're running towards. Then we're switching to the numbers piece. What is it that we're trying to achieve? Okay, when we know what we're running towards, what's going to fund us being able to have that choice in our life? And most people get attached. They'll be like, I want 10 houses by the end of the year. Great. What does 10 houses give you? It's generally a dollar amount. And so we're breaking all of that down on, the dollar amount that's actually going to get them to their end goal, but working backwards to create milestones along the way where that actual path is far more achievable for them. And it's only after we've done that hard work that we're diving into what are you interested in? What time do you have? And what is your capital? That's actually the third step. Once we have those three pieces together in the third step, then we're getting into setting our goals for the first year. Again, mapping out the whole business vision for the next 5 to 10 years. And then we're building the business. We're getting into the how, which is where a lot of people actually start, is the how.
Yeah, I love that same structure. I actually do something similar and I forget where I learned it, but I remember I heard someone say once that I needed to make a list of the wildest things that I'd ever want in my life, figure out how much they cost, and then just see what the total was. And they said that I would be surprised because it wouldn't be as much as you thought, even the most crazy things you could think of. And it's true. When you start thinking of all these ideas, it seems like it's going to be incredibly unattainable. But when you start to look at the numbers, it is a lot of money, right? If you want a mansion, it's going to be a lot of money, but it's something that's achievable. For me, I've always loved supercars. I'm a big car guy. I love motorsports, things like that. I've always wanted to own something like that. So I always thought it was going to be unattainable. But when you start to break it down at the numbers and you're like, okay, well, that's only 4 units, 5 units, 6 units, it starts to be a lot more realistic than, I have to save $500,000 or, whatever that number is.
I know Tim Ferriss in his 4-hour work week, he has a process like this. And there's buying your dream and then there's renting your dream, right? Do you have to own 5 cars, or can you just build up the cash flow to where you can rent a car a month? There's so many different ways to achieve a goal, but unfortunately, I see too many people start at the goal piece when they don't actually know what it is that they want.
Yeah, I mean, it's impossible to build if you don't know what you're building towards, right?
Yeah.
So I like to ask the guest to give the audience an actionable step to take when they finish listening to this episode. I think listening to the podcast is great. Learning everything that we talked about is obviously important. You need the educational piece of this. But for someone who hasn't done their first deal yet, but they're passionate about real estate, they want to get started, what is the first action step that they should take when they're done listening to the podcast? When this ends, what is the first thing they should go out to do that'll get them one step closer to their goal of buying their first rental property?
Yeah, rewind 5 minutes. Work those first 3 steps of those plans. I mean, really, I laid out at a very high level what that recipe is. So figure out what your why. Don't just ask it once. Like your first time you ask it, it's going to be something that you're running from. We want to dig deep and find out what you're running towards. So ask why like 4, 5, 6, 7 times. Challenge yourself. Sit with that question. Figure out what that end why is. Dig deep on your numbers. Understand what your finances are. Okay. Oftentimes people will pick a number out of the air, like be on an investor call and I'll be like, okay, like, what kind of capital are you looking to have? Like that will fund this why? And they're like 10,000 a month. And I always interrogate reality. I'm like, okay, why 10,000? And 99% of the time they cannot justify why 10,000. So we're backing into that number. The worst thing you can do as an investor is understand that your financials, you pick your financial goal based on what your income is, not actually understand what your expenses are and what will actually get you financially free. Because a lot of times people will replace their income only to find out that their income was not enough. And then third step, understand what real estate investments are you interested in? Understand what time that you have to put into this real estate investment. Make sure those two are aligned. And then we can start setting goals around that.
I think those are great action steps. So everybody listening to the show, when you're done listening to the episode, go take action on those things that Whitney just mentioned and get started one step closer to your real estate goals and make 2020 your best year yet. Whitney, thanks so much for coming on the show. I really enjoyed our conversation and I know the audience is going to gain a lot of value from it. For those interested in learning more about you, connecting with you, and just learning all about what you have going on, where's the best place for them to go?
You can find me at ashwealth.com. So ashwealth.com. You can also email me at ashwealthco@gmail.com.
I'll be sure to put links to both of those in the show notes so everybody can go connect with you there. Whitney, thanks so much.
You're welcome. Thank you for having me.
All right, guys. That's all I had for this week's episode of Real Estate Investing. I'll see you again next week.
Thank you for listening to TIP. To access our show notes, courses, or forums, go to theinvestorspodcast.com. This show is for entertainment purposes only. Before making any decisions, consult a professional. This show is copyrighted by the Investors Podcast Network. Written permissions must be granted before syndication or rebroadcasting.